Central Bank of Kenya has for the sixth time in a row left its benchmark lending rate essentially unchanged at 9%. The Apex Bank attributed the subsequent hold of the crucial rate to the optimum performance, in their view, of the general economy amidst volatility jitters both internally and externally. There's a broad range of factors explaining that. Now, remember, this is the last Monetary Policy Committee meeting which Dr. Patrick Njoroge is presiding over in his first term as Kenya Central Bank Governor. So what has the last 4 years been like? Let's explore that. Reginald Kazutu is the Chief Investment Officer at Amana Capital, who's in the studio right now. Welcome back.
Thank you, Ram.
So, first term, 4 years, how would you grade him?
I'll grade him on two scales. One which I'll give him an E for effort, because generally a central bank governor in a developing country, your job is not supposed to be just mere regulatory. It's supposed to be a bit promotional and developmental in perspective. So we'll have expected him to see an increase in capital formation in terms of savings and households through the commercial institutions or financial institutions, and that money ending up in the productive side of the economy, roads, infrastructure, and all. Now, that's a central bank that is concerned about economic growth in a developing country. In that front, I don't think he has done much.
But can we really blame him for some of those things? Because if you think about it from the perspective of if you're sitting in his shoes, right, and you essentially have your hands tied with something like the Banking Amendment Act of 2016, you've got no effective control of what savings rates are going to be, right? And that interferes with your job. It's literally a bunch of 200 and something legislators sitting back and saying, you have to set savings rates here, you have to set retail rates here. What can you do at that point? Your hands are tied.
Yes, and that's why I said I'll rate him two ways. On that one, I'll rate him an E. On the other one, which is now contextual, he came in, I don't think he understood the full extent of the mess that he was getting himself into. The other main job of a central bank is price stability, exchange rate stability, banking sector stability, and all. In terms of price stability, he has managed to keep a lead on the demand side of inflation, whether that was throughout his own genius or just because there's just no velocity of the money in the economy. So there's been no demand pressure. But we can credit it to him because we don't have evidence of the contrary. Exchange rate, we know how he has managed to manage the shilling at where currently it is, and it has not been volatile. So in those two, given the circumstances that he found himself in a very indebted country with a huge external debt, to manage to keep price levels and the exchange rate where they are is commendable. But
related question on that, because when you talk about inflation, and I know inflation targeting has been the sort of buzzword in monetary policy circles around this end of the world, but to the extent that the bulk of CPI in this country is food and its fuel issues, and these are two elements that, let's be honest, the central bank has absolutely no control over, right? It's not something you can tinker with by raising rates or reducing the amount of money that's in circulation. Playing around with M3 doesn't really matter. It's agnostic to that particular issue. Is that whole idea of inflation targeting even valid?
If I would quote the words of Milton Friedman, inflation targeting is literally nonsense. The only thing a central bank should worry about, depending on the school of thought of economics that you follow, is actually money supply. Because what money does in terms of the increase in the quantity of money in circulation or M3 is what actually either drives aggregate demand, national income, and employment. Targeting inflation, as you said, the inflation that we find on this side of the globe is normally cost push. It's not demand pull, and they have no tools whatsoever to deal with cost push inflation. But yes, it's fancy terminology to say we are targeting inflation. But really, what they should be more worried about is the growth of money supply. That's really what they have in their control at the end of the day. Because even interest rates are not in their control, because ideally they can set their benchmark rate. The market can decide to go whatever direction they want to go. So the only tool that the central bank actually has is actually money supply. Right.
Let's get back to what they said in the MPC meeting, because there was a whole range of, shall we say, contradictory numbers that were coming through here. Because on one hand, they point out to what they described as strong growth in lending, and manufacturing stood out because they were saying that we've seen a near 8% increase year on year up to the end of April. But you then turn around to the Industry Association and they say that their margins are flat or falling in the first quarter of the year, and only 20% of them are running even close at full capacity, roughly half operating at somewhere between 40 and 30%. So if you have more lending going in there and yet the company is operating at below capacity, there's a huge mismatch there, isn't it?
Yes, and it's something that we've been facing as a country, where statistics and what is on the ground, they are completely at different crossroads. Looking at the manufacturing sector itself, if you look at the Stanbic PMI, which gauges manufacturing sector sentiment in terms of they're going to expand and all that stuff, actually went below 50. Means that they are not expanding.
There's contraction.
There's actually contraction. So what are they borrowing money for is the question that comes. Or are they just trying to borrow to cover loans from the other side? But again, we look at it at the aggregate level. The total private sector growth is still way below 12%. Which is the central bank's target itself. It was around 4.35, 4.9. And as long as the aggregate figure is not increasing, then we will not see aggregate demand increase in the economy. Then it is also a bit foolhardy to increase lending when there is no demand. So I have
because
the loan.
Non-food, non-fuel inflation is actually pretty subdued. It's below 5%.
Yes, exactly. So you're giving me money to expand, but who's going to buy it? So I'll get the money, I will not expand. Actually, the banks are going to reach a level where people actually don't want the money, because what makes an entrepreneur grow their business or expand their business is the future return that they're about to get. It's the return they'll get from expanding. If I expand, I'm going to get demand. If there's no demand pushing manufacturing to expand production, then even looking at the rate of credit to that sector doesn't make sense. There are other things that we need to fix. And I think as policymakers, they need to look at more at policies that affect aggregate demand in the economy, and the supply side is actually not the problem.
All right, one last question, very, very quickly. Dr. Njoroge, second term in office, would you appoint him back?
Yes, I think I would appoint him back because he needs to keep the shilling where it is. Because if it actually goes to its real value, then the country is in a mess with all this borrowing that we are doing. Bring someone else in. I think what we need to do for the central bank is to depoliticize the central bank. Yeah. Because whoever comes in is still a political player. They have to play tune to what the government wants. Unlike like the Federal Reserve, they make their decisions independent of the government of the day, to the best interest of the public and the country as a whole. Country like central bank doesn't do that.
Okay, we'll leave it there for the time being. Reginald Kazutu, thank you very much.